If you want to be a profitable trader, you need to avoid the mistakes that I'm going to go over in this video. I see a countless amount of people making these same mistakes over and over, and they're the same people that are questioning why they are not making any money. They are simple mistakes that could easily be fixed once you are aware of them. Now, on my Instagram a few years ago, I posted about successful trading, and this is going to be the basis to this video. If you're not following my Instagram, I will post a link in the description below to do so. I post really good trading tips and tricks, daily trading recaps, and stuff you're not going to find anywhere else on the internet. The link will be in the description below to follow me on here. You're missing out if you're not. The first mistake I see a lot of traders do, especially beginner ones, is they're looking for a holy grail and they strategy jump, meaning they're bouncing back from strategy to strategy. They watch one person's video, they try his strategy. They take one single trade off of that strategy, it's a loser, and they avoid it. They never do it again. They watch somebody else's video, they try his strategy, it loses, the process keeps repeating, and they jump from strategy to strategy. Stick to one trading strategy and master it. You can make money with any single trading strategy. I never will make fun of somebody for how they trade, because if it works out for them, then keep at it. However, I want to avoid those traders who are jumping from strategy to strategy. Stick to one strategy, master it, scale it, and build upon that. You must know how the auction facilitates trade. So I slowly want to get people, if this works for you, keep at it. But a lot of traders watch similar videos of all these holy grail magical indicators. They try it and they are lagging price, meaning they are getting in after the moves happens, because they're focusing on indicators that only plot price after it moves. Or what I mean by that is the indicator changes once price has already moved. Those are lagging indicators. You must focus on real-time indicators, and we must do this by first knowing how the auction facilitates trade, meaning view the stock market as any other auction, and how we can relate any other auction of buyers and sellers, we can relate to the stock market, and that will give us an edge in itself. The edge is understanding that nothing moves price besides volume and price itself. The only way price can change over here is if volume changes price itself. I slowly want to start seeing a lot of traders' charts, if you even use charts, to be as naked as possible with only true, leading, not lagging price action indications. Sometimes I don't even look at a chart to make a trading decision because I'm reading the auction of volume and price itself. The best traders that I know don't even put much emphasis on charts. And for me personally, I can only speak on myself. It's supply and demand zones and reading the tape, understanding the level 2 and time and sales, because this will help us understand how the auction facilitates trade. Another reason why I see so many fail is because they are focusing on too many things, which is causing too much noise and many distractions, avoiding from what really is the most important. Think of a phone. If a phone is cluttered with all its storage used up, maybe you got a 64 gigabyte phone and 63 gigabytes of it's used, that phone is going to be really slow, and you're not going to be able to function properly using it because of how slow it is. As a trader, we're the same way. If our brain is cluttered with too many things that are not important, it's going to cause so much noise, and we are going to be thinking about things that are not relevant for us to be making profits. Get off of Twitter if you need to. If you find you're scrolling through Twitter throughout the day, looking for other people's charts, you're waiting for other people to post what they're in or what they're out, or what level they're watching, get off of it. If it's a distraction, stop it. If it works for you and you get value out of it, keep at it. But a lot of people are following signals, following alerts, following so many other people that his opinion is clouding your opinion. And the other guy's opinion is clouding that guy's opinion. And it's just noise, and it's a cycle of back and forth with too many distractions. Another thing, I see a lot of traders getting caught up in the news. For me personally, I do not care about news. I'm a short-term trader, and going back to point number 1, I care about price and volume itself, about how the auction facilitates trade. Sometimes news can be priced in, or sometimes we could see price preceding news, especially if we're, let's just say, in a supply or demand zone and good or bad news gets released. As a short-term trader, I do not put much emphasis on news. I don't care about it, and I hardly look at the result of the news. It's important to know that there is news, especially if you're in a position. But if you care so much about the news and what effect it's going to have 3 months from now, it's irrelevant if you're a short-term trader, and it's more noise causing too many distractions. A lot of traders fail because they deviate away from their own trading plan. Let me ask you something. If you have a plan and don't follow it, then why did you even create that plan to begin with? If you make decisions outside of your trading plan, not rational ones, to what the market's providing to you, then it's an emotional decision and you will struggle as a trader, and it'll be very hard to be profitable if you make emotional decisions away from your trading plan. For example, let's go over the pre-market plan from this day on the S&P 500, where I said I do not want to get short, especially if ES and SPY is above 4,100 to 4,090, which is this green box here. If sellers can become trapped, this is going to offer a possible upside short-term reversal. I don't want to get caught short below this level at 4,100. Now the market opens up, and let's just say we're an emotional trader. They see a large red candle. Let's ignore the fact that we had demand here, but we did have a valid trading plan saying, okay, we cannot get short here just yet. But we see the market coming down. We're like, oh, it's breaking 4,100. Let me just play the market short, even if I could scalp this for a quick 10 points. Well, if we just had a plan that said we can't short it, why would you short down here? And why would you even create that plan to begin with if you're not going to follow it? Because you would have got your face ripped upon, and the market rallied very, very hard from this little demand zone if we just followed our plan and we didn't deviate away from that. If you have a plan, stick to it and follow it, and watch how more structured your trading will be, and watch how many more good trades you will take. A lot of traders are their own enemy and they prevent themselves from having success, but they take one trade that was a $5,000 loss or such a big loss that it wipes away their wins, or they just do not even define the risk before they enter that trade. So what I have to say to this is there should be no such thing as a large loss in your vocabulary. If you have large losses, you're your greatest enemy, and it's going to be very hard to consistently make profits. I've said this in plenty of videos before, especially my most recent ones. You must know exactly how much you are going to lose if you are incorrect before you enter that trade. And if the risk is way too high and you cannot afford to lose that much, then you simply do not take the trade. For example, on the S&P 500 right here, the market sold off and we are slowly starting to bounce off of this intraday demand zone. Also, it lines up with VWAP. We have multiple signs of confluence. I'm going to take the market long, 5 contracts right here at 4,040. Now, what I'm going to do is I'm going to put my stop loss below this wick right here at 4,037. So what I will do now is I will go to the active trader and I will lose about 3 points. And on 5 contracts, my stop loss is going to be about an $812, $875 loss. So before I even clicked that buy button, I could calculate that, but just for simplicity purposes, that will be my stop loss, and I will lose only 800 bucks. Now, if you're looking at this trade and saying, oh, 800 bucks is way too much money and I can't afford to lose that, either A, size down, or B, don't take this trade at all. You must know your risk before you enter. And if the risk is too large, don't take the trade. And going back to the point number 3 is if you have a plan, you know where your target and your stop loss is going to be. So if you do have a large loss, that means you're not following that plan. You're letting your emotions get the best of you, and you're holding on to a losing trade for way longer than you should because you cannot obey your stop loss. That boils down to emotions, especially discipline. I see a lot of beginners chasing moves, meaning the market rally, and they see it break out and they chase it. Or they see it sell off and they don't want to miss out on playing the market short. They short it after an extended move and they are chasing it. This is called the fear of missing out. If you miss your entry, do not chase it because that's going to skew your risk to reward. If you skew your risk to reward, you cannot afford to lose as many times as you would like because your risk is going to be higher than your reward. You always want to make sure your reward is going to be higher than your risk. For example, let's just say I missed this bounce off of demand and I wanted to buy the market all the way up here. Well, if I'm buying all the way up here, where am I going to put my stop loss that invalidates my thesis? For me, it would have to be all the way down here. Now, if I entered down here at the first oval, my stop loss is going to be below this low. my risk is much smaller compared to my reward. And let's just say my target is all the way up here near the highs. If you chase a move, you are skewing your RR. I'd rather miss a move than chase it and lose on it. I took a very large loss when I first started trading, and I talked about this in my trading journey video. I'll post a link for that in the description below as well. If you haven't seen my trading journey video, I talked about how I blew up accounts, and it was essentially not having a plan and chasing the market. What I saw was the market coming up, and I shorted the market. Didn't have a plan, had no reason to short it, just because it didn't make sense that the market was so high. Then it kept going up, and I kept shorting it, I kept shorting it, and I kept shorting it. I was chasing a move by not having a plan. If you don't have a plan and you are chasing it, it's better to just avoid it and not take that setup. Because once the momentum's going, there's nothing that could stop it. And this is how you have a large loss like I did when I first started out trading. Probably the most important one is never compare yourself to others. I see so many people in the trading industry comparing themselves to others. And this is even going back to Twitter. They log on to Twitter. They see some paper trader posting a $50,000 profit on a paper account. They're like, oh, this guy is so good. I want to be just like him. And they're comparing themselves to this guy that's probably been trading for 6 months, posting paper gains with a large following. Or they see other people in a community making consistent gains and they're trying to figure out how they're doing it. Everybody's got the same resources. Stop comparing yourself to others. You're running your own race and you're going on your own journey. The other guy might have more years of screen time and experience. The other guy might have a different strategy. He might have taken more trades in his past than you have. Or he might take more trades on a daily basis than you do. Everybody's different. We're all unique, like a fingerprint on our hand. My fingerprint's gonna be different than yours. And if you try to compare them and make them identical, you're gonna struggle and you're gonna have anxiety when you're trading because you're comparing yourself to somebody else and you're not focused on your own self. It's sick to be your own self and your own profits. So I think that's pretty much it. I can make this video with 100 different points. If you want me to make like a part 2, let me know. Make this get 1,897 likes and I'll do like a part 2 to this. Comment if you have any questions, drop a like, and definitely check out the links in the description below. But I'm gonna end it on that note. Peace out.